It's again jostled by uncertainty. Moscow has finally delivered a long-awaited response to the price cap, signing a decree that bans the export of Russian oil. The epidemiological situation in China is deteriorating. The country reports a sharp rise in infections ahead of an easing of restrictions and borders reopening next month, which is likely to disrupt economic activity and reduce oil demand in the world's largest oil importer. All this time, the United States is working on resuming oil production in the Gulf of Mexico after winter storms. So the energy market's reaction to the decree signed by the Russian president turned out to be somewhat mixed. On the one hand, a complete ban on oil and petroleum product sales immediately led to higher oil prices. On the other hand, the clause stating that the ban applies exclusively to contracts that directly or indirectly envisage using a maximum price fixing mechanism somewhat reassured investors. As a result, the quotes returned to the levels they were before the publication of the decree. After all, no one forbids excluding any reference to the price cap from contracts, but concluding them at prices corresponding to the restrictions imposed. At the same time, it's worth paying attention to the fact that this ban applies to the entire supply chain. That's even if a certain third country formally acts as a buyer and then resells oil to Europe. Apparently, this clause is included because European bureaucratic norms require a company to prescribe compliance with the existing legislation, including sanctions regimes. Now, market participants will closely monitor the reaction of Brussels' bureaucratic bodies. However, official statements are expected to follow only after the winter holiday season. Until then, the market will probably remain in limbo. From a technical point of view, Brent crude oil futures are moving in the range of $84 and $85.50 per barrel amid mixed trade curves. Working within a given range is rather risky. In this situation, the best tactic is to trade with a view to breaking through one or another boundary of the range. The ruble's first reaction to the decree signed by the Russian president was negative. The Russian currency slid as expected, and now the dollar-ruble pair is holding steady above the level of 70, which signals potential gains. The volume of long positions will increase further after the price consolidates above the area of 71 or 72. In this case, the dollar will have a chance of hitting a new local high. Until then, the pair will probably keep moving around to the 70 mark. The market is still at a loss and is trying to mull over the effects of Russia's decision on the global energy market. The ruble is predictably losing value amid uncertainty. By and large, not much depends on the reaction of Brussels. After all, the key issue is the possibility of European companies not to mention the price cap in the contracts for the purchase of Russian oil and oil products. If so, the decree signed yesterday will not have a major impact on the energy market, and this will make investors think that Russia has come to terms with the price ceiling, which may lead to an even steeper drop in the ruble. However, the situation will become clear only after the New Year's holiday season. Until then, the dollar will most likely remain around 70 rubles. Like almost all trading instruments, gold is standing still due to the Christmas and the New Year holidays. Trading activity is subdued and will most likely increase only next year. The outlook for the first half of 2023 is rather gloomy. Major central banks are set to keep raising interest rates at least until spring, which of course will put pressure on the yellow metal. Notably, back in the summer, analysts predicted that gold would dip to $1,600 per ounce. However, it managed to stabilize around $1,800. So we cannot exclude that the coming year may bring surprises. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.